participants of our virtual webinar. So the title of this webinar is the Cleanup Call RBI Action Against Lending Practices. In recent times, we have seen various critical issues of lending practices have come under the scrutiny of RBI. The RBI has not only voiced concerns, but has also taken decisive steps to address certain practices which are deemed questionable and unjust. The severity of some measures underscores the urgency of understanding the underlying factors, recognizing what constitutes unfair practices, and examining the implication for lenders. In light of such regulatory actions, it is important to note that the process of executing administrative and regulatory actions, the avenues for representations, and the right to appeal are not just procedural formalities, they are the bedrock of a fair and transparent regulatory environment. These considerations gain paramount importance when the repercussions of such actions transcend individual entities and begin to influence a multitude of stakeholders, potentially reshaping the entire financial sector. We at Vinod Kothari Consultants have been actively discussing and engaging ourselves with such contemporary topics every now and then. Today, we have gathered here to critically examine the severity of the RBI's action and their implications for lenders as they navigate through an ever-evolving financial landscape. It is our honor to have with us our panel of esteemed dignitaries whose illustrious careers and significant contributions to their fields have earned them acclaim and recognition. Their insights and experiences promise to enrich our discussion with unparalleled depth and perspective. I would first like to welcome Mr. Tomal Bandhopadhyay, who is a renowned authority in financial journalism and brings decades of expertise to the table. His work has significantly influenced Indian banking reforms and discussions on regulatory frameworks. An author of multiple acclaimed books, today he offers his valuable insights into the evolving financial landscape. Thank you, sir, for being a part of this webinar today.
Thank you.
It is a pleasure to have Mr. Chandan Sinha join us, who is a non-executive chairman at RBL Bank, bringing over 4 decades of expertise in banking and finance. His distinguished career includes serving as executive director at the RBI and leadership positions post-retirement, including interim director at CAFREL. With educational credentials in physics and finance, Mr. Sinha offers valuable insights into the RBI's recent financial measures. Welcome, Mr. Sinha.
Thank you.
I would now like to introduce Mr. Sachindra Nath, a distinguished figure in Indian financial sector and executive chairman of Ugro Capital. With over 20 years of experience, he has significantly contributed to MSME lending innovations. An expert in multiple financial disciplines, Mr. Nath is a CFA and a law graduate dedicated to advancing financial inclusion. Today, he participates in this panel to share his perspective as a key stakeholder of the NBFC sector. Welcome, Mr. Nath.
Thank you.
We have with us Mr. Anand Shah, Senior Partner at AZB and Partners, a distinguished figure in corporate law, specializing in mergers, acquisitions, and capital markets. Known for his strategic expertise and legal prowess, Mr. Shah has been instrumental in advising major corporations and financial institutions. A University of Mumbai alumnus and Bar Council member, he is committed to excellence in legal practice. Today, he joins us to impart insights on the financial sector's evolving landscape. Welcome, Mr. Anand.
Thank you. Thank you.
Lastly, I would like to welcome Mr. Vinod Kothari, Director at Vinod Kothari Consultants, to moderate today's session. With over 30 years in the financial sector, Mr. Kothari's experience in structured finance and securitization has been a part of several policy reforms in the Indian financial sector. An esteemed author and speaker, his extensive works and speeches have garnered international recognition. We thank him for moderating today's session as we delve into the experiences and insights of our panelists. As we proceed with today's session, let us keep in mind that the objective of this webinar is not only critique, but also to construct a collective endeavor to envision a future where lending practices are fair, transparent, and conducive to the overall health of the financial ecosystem. A warm welcome to all the participants and panelists once again, and I would now like to hand over the proceedings to Mr. Kothari.
Thanks, Anita. Thanks for nice words of introduction, and also thank you for setting the backdrop to today's discussion. As the webinar is titled "The Cleanup Call," and I think pre-Deepavali, all of us do clean up. We clean up our houses, we clean up our offices. So this is also sort of a cleanup call. We try to see if we need to clean up our lending practices. The cleanup call is not limited to lenders. Quite often it also extends to the regulators and see if there is something that we'd like to clean up, is something that we like to maybe tweak or reform or maybe readjust to the emerging reality. No one is away, no one is beyond the cleanup call. So the cleanup call is something which is all encompassing and includes everyone. So let me first start by allowing all the panelists to say hi to our audience and also build up the first initial dialogue with the audience. And therefore, I would put a very simple, very brief question. You may choose to answer in a word or some words or maybe a few words, but probably keep it brief because that's just an initial dialogue, and I would have a lot more to ask you and quiz you as we proceed further. So I'll be sort of circulating to all the panelists to ask you, how do you explain, how do you describe the recent actions of the RBI against lenders? Sometime back, lenders were given advisories in respect of gold loan practices. Before that, there were advisories for microfinance. There have been intermittently advisories on asset reconstruction companies. There have also been cases where cease and desist orders for particular segments of business have been given. But the most recent press release of the RBI that we're talking about is one where complete cease and desist has been ordered against not one but 4 different non-banking finance companies, including microfinance companies. Mr. Tamal, can we start with you? How do you describe this action? Do you find it unreasonable, unprecedented, exorbitant, sharp, severe, or do you say that the lenders earned it for themselves?
No, I think it's an exemplary action. It's basically telling the world of NBFCs. We have about 9,000 odd NBFCs under different layers. Nothing on the top layer, but upper, middle, and lower. And all 4 belong to the, if I'm not mistaken, to the middle layer. So it's an exemplary, I will not call it exemplary punishment, but exemplary action. Those who have been doing things, it's not only for them, it's for the entire industry. Look, you better do things correctly. That's all. It may sound sudden for you and me because we don't know what was happening in the run up to it. We'll talk more later. I don't want to because you said it has to be very brief. So in one word, this is an exemplary, not for the 4 entities only, but for the entire sector.
That's a sort of, that's sort of a clarion call, a sort of a call for everyone to be on the caution, be on your feet, because this is something that 4 can face. Maybe the rest of you also, if you have similar practices, you can face a similar action. Chandan sir, what would be your take?
I would just say not unexpected, given their public stance on non-compliance and customer centricity. See, this message has been coming time and again, and we have seen action on other fronts, which you rightly mentioned. So not unexpected. And as mentioned already that, from a universe of almost about 10,000, maybe 4 have been picked up. So we should also look at, the scale at perhaps, at least at this stage, it's only 4 out of, a very large set.
Population, right. Mr. Nath, what would be your take?
So the way I would think that agar aap jab chote the, if you remember, and when there was a class which was very noisy, how the teacher would react. So teacher would not punish everyone. It's impossible to silence a class by shouting at everyone. So when a teacher used to enter and the class was, rowdy, he would pick up one of the child and slap him. What used to be action after that? The class would go silent for rest 2 hours. So this is the slap. Unfortunately, sometimes the slap can be to real culprit, and sometimes it can be to a guy who was less shouting, but he caught the eye of the teacher. So unfortunately, it is you're part of a noisy class, and you may be less noisy, but the teacher got his attention onto you, and you have been slapped for the purpose of keeping the whole class quiet.
So basically echoing the same thing that Mr. Tomal mentioned. It's basically exemplary. And I think three of you actually by and large said the same thing. Anand sir, what's your take?
No, I don't think there is a different view on that, right? I think it's truly an exemplary action in that sense. But if you stand in the shoes of those relevant NBFCs, unfortunately, it probably looks a little excessive, right? Because it's a complete cease and desist in that sense. It's a strict action, very, very strict action in that sense. So significantly does impact them. So while exemplary is always sometimes required, but in the shoes of those NBFCs, I think a bit excessive. Of course, we don't know what's happened behind the scenes. RBI inspections are confidential. We don't know what has happened. Were there warnings in the past? Because the regular inspections would have happened. Maybe there were warnings, maybe there were not. So we don't know what's happened on that front to really comment on it from the outside. But without sort of having that view, just purely on the outside, it does seem a little excessive to me.
Absolutely. I mean, like Mr. Nath mentioned, if one person in the class is slapped for making the rest of the class silent, depends on who you are. Are you the one who's been slapped, or are you the ones who just been silenced?
That's it.
Being silenced by slapping someone is always still okay, but being slapped probably is not. But anyway, let's proceed with this. So I think just want to kind of just give a little context, because I'm sure everyone is aware, but we talk about number of NBFCs, 9,000 or NBFCs. By the way, the actual number of NBFCs which are in lending business would barely be, I would say, 600 to 700 NBFCs odd. Yeah. The number 9,000 looks quite stunning. Quite often, everyone, I mean, from across the world, people say, oh, 9,000 companies, and people get really swayed by the number. But this is because the way the RBI Act has been defining non-banking finance companies, a whole lot of companies which are completely into investment business, have nothing to do with lending business at all. Because the jargon is investment and credit companies. So investment companies also get clubbed. They have no way to interact with the financial sector at all. Neither are they kind of raising any public funds. On the funding side and the asset side, they have nothing to do with the world of finance. Still, because of definition being how it is, they are treated as non-banking finance companies. Now, that's a point which might take us a long discussion. Therefore, let's not get into that. But Tamal sir, coming to you now, you have been observing and writing on the banking sector, including the non-banking sector, over the years. And you would have very obviously observed there is a greater interconnection now between banks and non-banking finance companies. Earlier, banks were buying their portfolios by way of the so-called securitization or direct assignment. Now there's even a greater sense of partnership, because most of the banks are now connecting into loan partnership with so-called co-lending arrangements. And most of the NBFCs currently have the so-called co-lending arrangement with non-banking finance companies. How do you see this increasing interconnectivity between banks and non-banking finance companies? Are you kind of finding this is overall permitting the banks to increase their outreach and reach out to, increase financial inclusion? Or do you think that this dependence of the banks and non-banking finance companies does bring any risk to the financial sector in general? I'll come to the next question once I hear your view.
I think we need to first see that the background. In 2024 we are talking about COVID is behind us, DFHL and DHFL and ILFS 2018. That's what happened. Then 2020 Yes Bank. So if you see what happened in banks and non-banks in the past few years, it has changed the regulators who are looking at the financial system. This RBI is very different from other RBIs. This RBI is very democratic. If you see when it coming to take action, it doesn't care who you are, how politically well connected you are, which entity you are, be it a non-banking finance company, be it a gold loan company kind of thing, be it a bank, very well-known bank, be it a payments bank. This RBI is very hard hitting because it does not want, financial sector stability is at the top of its mind. But does that mean that it's at the cost of this financial sector, meaning this interconnectedness will create a chaos? I don't think so. I don't think so at all, because this coexistence and this reciprocation and the relationship between banks and NBFCs, yes, there is very crude way of putting it. The banks need the NBFCs because they are not been able to fulfill their priority sector lending norms. So give the money to NBFCs, and that's how you create that. You buy assets from them, and that's how the so-called securitization you're talking about. That's one of the things. But other part is this: there are multiple ways you do collaborate, you do coexist. That's what is happening. I think that's the new architecture of Indian financial system. And this kind of yes, there is a jar, like as we see that 4 guys which have been punished. They will find it difficult to get bank loan. Liquidity is an issue. It's very difficult because and once you are not being able to get new customers, give fresh loans, that cycle stops at some times. I don't know. I wish them luck. I'm sure they have a plan in place to do that. But there are others are being affected. I've come across many instances where they said, look, my bank said no, loan was sanctioned, but they will not disburse. Somebody said, look, we are about to sign off the BC agreement. Now the bank is saying no. So yes, there will be a temporary problem at this point of time because of at a stage you hit 4 of them. But in the long run, in the medium run, why will this architecture be affected? The co-lending is one form of thing, but essentially coexistence and collaboration. I think both banks and NBFCs, they understand this, and that's the way to move forward. So there is no change in this. And RBI is completely aware of this interconnectedness. I don't think it will do anything which will affect and create a chaos and affect our financial sector stability, because that's Reserve Bank of India going beyond inflation control and setting the rate, policy rate. It has multiple other tasks. Not too many central banks in the world does that. And I think at the top of it is the financial sector stability. So at any cost, I don't think, knowing the current RBI psyche, if I understood, it will jeopardize.
Very right. I think the word that you mentioned is extremely important. It's not just co-lending, but coexistence and collaborative financial system. So very, very important contribution, Mr. Tamal. Coming once again to the bank NBFC partnering, most of the NBFCs, I'm sure, as everyone understands, are into personal lending or retail lending, as we call it, which may include to an extent the so-called MSME lending, but most of them are into retail-focused businesses. And this retail lending activity of banks and NBFCs has come for regulatory attention quite often. Sometimes the sharp growth in personal loans has been published in papers as if this is something which is promoting consumerism. Ultimately, this money is getting into spending. Young people, 20-somethings, are tempted to get into loans for basically spending in restaurants and pubs. And therefore, the easier the loans are, the more wasteful or the more consumeristic is the spending. Mr. Tamal, as a financial journalist, how do you look at this development? The money getting into our promotion of personal loans. Is it something which you would like to see growing in the economy, or do you think this is the cost of our productivity?
I think you are mentioning that you're not naming them, but you are referring particularly to the loan apps and that buy now, pay later. That kind of system which has been now there. Yes, one can have one's daughter's birthday and order the cake, having the money. One can have 4 of us can have some beer at a bar and getting money from through loan apps. Actually, I saw it in Kolkata bar once. 6 guys were drinking beer, and I checked with them. They're all university students. They take money at 40%. And the hook is this: once you start taking money and you regularize, and then you get into the credit bureau, and later you get it cheaper. So I think that this fad is there, but will they last for long? I'm not very sure. because the Reserve Bank of India is pretty aware what's happening in that segment. That's actually, I don't think what happened in the NBFC segment and this we should get confused and we should mix the two. That's a separate story altogether. But having said that, the concern about unsecured retail credit, I'll just go beyond this. I mean, why are the concern? I think what happened is this, even though there is no proof, but many of the analysts feel that maybe it's getting in the stock market and F&O segment, so on and so forth. People are raising money and not for even consumption or any other or productive purpose is getting into the market. That's one part of it. And second part of it is the rural areas. What happened is this: people are encouraging over leveraging, but there is a rural distress where, I mean, we may keep our eyes closed, but happen to that the food inflation is far higher, growth is lower. I mean, I can reel out the numbers. If you look at the tractor sales, if you look at the low end two-wheeler sales, etc., etc. So in rural India, this is the phenomenon. People are actually essentially taking money for consumption because the growth is pretty uneven, and there are issues with the rural India. There money is flowing and money is flowing abundantly, and some of the NBFCs are taking advantage of people. I mean, they are encouraging them to over leverage without knowing. This is basically what Reserve Bank of India is talking about, the push factor. It's not demand driven, it's driven by push. That's happening in rural India, not everywhere, but at many places. And in urban India, the concern is this: money is not going for productive purpose, neither for even regular consumption is getting into the stock. I think these are the two underlying themes in urban India and rural India in official time happening, and that is the worry.
When you talked about borrowing money in the beer bar, and you talked about rate of interest of 40%, I think you were being modest. And therefore, as Mrs. Sinha is nodding, let me come straight to Mrs. Sinha. Mrs. Sinha, the RBI has quite often been talking about excessive rates of interest. Quite often when they come up with this observation, they say the rates of interest being charged were excessive. And one common question in everyone's mind is, what is excessive rate of interest? Ask what is excessive, the answer is exuberant. Ask what is exuberant, the answer is unreasonable. And ask the question, what is unreasonable, it comes back to excessive. In a sense, it's a circularity. There's no way to numerically explain what is excessive. There's absolutely no number. In the past, there were some net interest margin caps on microfinance entities, which have also been done away with, which means the complete deregulation of rates of interest. While we deregulate, yet there is no regulatory statement on what is unreasonable. And quite often regulators come and look at the rate of interest, the so-called annualized percentage rate, and say this is unreasonable. Now, there are 2 points I have here. Number one, quite often what matters is not just the rate of interest, but the absolute amount of interest. And quite often I give an example that if you talk about a loan for few thousand, let's say 1,000, and people do borrow 1,000, not for drinking beer in the bar, not necessarily. They also borrow 1,000 for repairing the credit history. If I have impaired credit history, I take a fresh loan, 1,000 rupees. I paid back in 3 months. Then I take another loan of 500 rupees paid back. Probably my history improves. I have not done that, but I'm told that that's how it happens. So there's small amounts of money. If it's borrowed for, let's say, 1,000 rupees for 3 months, rate of interest may seem to be 48 or 50 or 60 or whatever, but the amount of interest is just trivial. Now, given the fact that the loan acquisition costs are incurred in absolute numbers, they're never acquisition costs, meaning the cost that you pay for underwriting a loan, or let's say for someone intermediating and giving you the loan. These costs are absolute numbers. They are never in percentage terms. So regulators talking about excessive rates of interest, looking at rates and not talking about absolute numbers, and there being absolutely no guidance on what is excessive. So even if people were to follow and see introspective, my rates are excessive, what guidance do you have? I'll come to Mr. Sinha first and then move to Mr. Nath on the same question. Mr. Sinha first.
This is not, this is somewhat complex, but, actually what you are saying is it's going back to the perennial debate on what matters, whether it's the availability of credit which matters or it's the cost of credit which matters. Now, this is, something which has varied over time, and it varies from, person to person. You can argue on both sides and kind of justify that, So at that level, as a country, I have seen, make available, that's what is needed. And what you are arguing is I'm making something available which otherwise we didn't have access to, and therefore I charge for it. So that's one side of the argument. The other is no. Who are the kind of people you are dealing with? Are they having, kind of, equal access, or they are equally well informed? Are they financially literate? Are they vulnerable in some way? And then you have some kind of a responsibility, and therefore some kind of a cap should come in. So my take is, because it can vary, is that, the RBI registration to regulated entities actually gives you a kind of a license to raise public money and access to bank funding at a reasonable cost. And therefore, it casts an obligation also on you to on-lend by adding a reasonable margin to it, to your cost. So that's fair enough. Till March 2022, it was indicative of around 12%, right? Now, what happened in 2022 directions, if you look at, that gave you flexibility, it didn't give you freedom. So people have confused flexibility with complete freedom to do what they would like. I think that is where I feel, a little bit has got kind of confused. And that particular, regulation directions also talks about usurious interest rates, and, also talks about RBI will be kind of revisiting, having a look at what the interest rates are being charged. There will be a supervisory review of that. And perhaps that is what they have done. So whatever interest rate, there are two aspects which we all agree. It should be fair, it should be transparent. Now, the question here is it fair to the person to whom you are charging? And that is something which I feel has to be decided independently and not by that entity itself. Now, who could be that such entities? Actually, the best would be the industry body, because if they are really vibrant, if they have information, they could actually guide and see that this doesn't become an issue in the industry. And as has already been said, this particular industry is prone to contagion effect. So one bad thing happening to one entity actually starts affecting the rest of them. We have seen that. So it is everybody's responsibility, including that of the industry body, to kind of police this in a kind of a lenient way, but ensure that. The second is the regulator, because they are another body who has a industry-wide information, because they are collecting information from across the country. They have that information, so they could opine on this. And obviously, they would have looked at what is the median kind of interest rates, who are the outliers, who are not. And when you pick maybe 4 entities on that count, so obviously they would be outliers in some major way, is all that I would say. So let us keep in mind, not just the technical aspects of any regulation, which is, there's a contract, there's an agreement, and I have actually my key fact statements mentioned in, and then you have to actually look at the spirit. The spirit was never to kind of, use this as a freedom, this flexibility as a freedom, and then add on cost, and maybe, so ultimately it will translate to some kind of profitability indicator for you, right? And I don't know, sometime back, I think Sadhan, they mentioned about an ROA 4%. I don't know whether it's agreed, disagreed or so. So let us look at, the things in totality, and then opine whether it is, excess, fair or not. So that is what I would like to
Thank
say.
you, Mr. Sinha. Thanks for these extremely enriching comments. Mr. Nath, I come to you, but also with little extended question. Mr. Sinha mentioned about well-informed borrower. He talked about a borrower is financially literate, and then he talked about something which is fair and transparent. And he also talked about key fact statements. And Mr. Nath, as you are aware, that currently disclosure of annualized percentage rate, which includes not just the rate of interest but the upfront fees, is mandated. The key fact statement is to state all the terms of the loan to the borrower. The borrower also has a choice. Gone are the days when the borrower was without choice, because plenty of lending apps and plenty of lenders are coming with each other to offer the loan to the very same borrower. The borrower has a choice. The annualized percentage rate is disclosed to him. He knows what is borrowing at, and still he chooses to borrow at that rate. are we somewhere missing? Are we missing on fairness and transparency somewhere? I'm not advocating in particular case, Mr. Nath, but I would like to hear your perspective here.
Yeah, so first as a disclaimer, whenever you attend a panel wherein the issue being discussed of banning, or issue is started getting discussed because there is a ban on 4 NBFC, as an industry participant, I want to clarify that, as a Ugro, it's a 6-year-old company. We have done 10,000 crore of business. We have 1,30,000 plus customer. I personally, as a founder of this business, is anti-consumerism, right? And the whole premise of Ugro being India's largest, aspirationally to be India's largest MSME financing, because in my personal view, when you lend for small ticket consumer loan and personal loan, there is nothing for the country which you are doing. So that's why we focus on purely on MSME financing, and most of our customers are literate customers. So a lot of problems which are happening right now, neither I have understanding nor knowledge. I'm just generally talking as an industry. That's point one. Number two, I think so that this problem, to some extent, within the NBFC space, is limited to few. So, I keep analyzing all the banks and all, NBFC in at least in listed space. If you take all listed banks, predominantly all listed bank, the return on asset ranges from, I would say, worst bank would be at 0.8, best bank would be 2%. A median is around 1.3, 1.4%, which means that if you leave across some banks business model focuses them to more diversified, lower yield and higher, much more risk covered portfolio. And that's why NBFCs exist. But within NBFCs also, the best in the pack would have around 8% of return on asset, where, worst would be around 1.2, 1.3. Best median is around 2.5%. Now, 2.5% return on asset means that if you take the total asset base of NBFCs, actually 70% of total aggregated outstanding loans, 75% is covered by top 5 or top 7. And their return on asset is not more than 2.5%. 2 of them are above that range. So what it tells you that this is a problem which is not all pervasive. This is a problem for very select few. Now, what is excessive and what is not excessive? Now, there is a very conventional debate, as Mr. Chandan Sinha said. Actually, this is more philosophical than what India needs more credit. More credit means more capital. And unfortunately, capital comes either from public market or from private equity industry. For people like us, all of our capital have come from private equity industry, which means as financial sector, to be, look long term and build a sustainable business, have no premium. So when the stock market goes, 100% up every year, when, small shopkeeper go to an SME exchange and get oversubscribed 107 times, and when as a lending institution, you deliver only 2% return on asset and deliver 11, 12% return on equity, you get capital starved. And when you get capital starved, so credit would start getting starving, right? Because ultimately, whether banks or whether NBFC, if they don't keep getting injection of capital, then obviously credit would get starved. To some extent, also there is a level of greed. There is a level of greed into the ownership and entrepreneurs who want to create more wealth for themselves than to think about creating long-term sustainable business model. And that's why some of these practices, because you want to show, disproportionate profit because you are competing for capital and you want valuation to go up very, very significantly. So there is a, and that's why in last governor's statement, first time in the history of, governor's statement, I heard this statement saying excessive private equity capital is also leading to some of these practices, right? He made two comments. And also excessive compensation linked to direct disbursement. So, it was as much as in your face when these two problems were identified. But other side of it, and I don't think so that is a problem largely in MSME financing, but the other side of it, that there is a cost of doing credit for certain segment of the market, wherein the most cost of credit plus cost of operation is excessively high. Now, should we exclude those segment of the market and don't do credit at all, right? If you just look at high level, it looks like that, that is what RBI is telling. But actually, honestly, not. What Mr. Sinha said that if the entities look at their cost of capital, look at their targeted return on asset and return on equity, and be fair and reasonable. Now, there is too much to decipher that. But if the entrepreneurs, the professionals, the management, the board become really conscious of what is fair to a customer, I don't think so this problem would happen. But I think so we have to balance, we have to balance between the need of capital, the need of valuation, and excessive growth, and what we are delivering. I think so it is something for us to solve. Now we are being slapped, or one of us being slapped for everyone to improve. I hope that everyone improves, but this is much bigger, deeper problem than just talking about ban of 4 NBFCs actually.
I think you are absolutely right, Mr. Nath, that the cult of private equity and particularly the short-term focused private equity investors.
No, public market, more so public market actually. So
and in public markets as well, because you need to report good numbers, you need to report healthy GNPAs, you need to report absolutely fantastic ROI and ROAs. And that becomes a compulsion. It becomes a sort of syndrome for everyone, because I was reporting 40% CAGR in the past, therefore I need to report that. I was reporting ROE of upwards of 30%, therefore I need to report that. So that your own actions become compulsive for you to be in this frenzied race for better numbers. And that's exactly what brings us to the next point, which is the point of...
nobody reports 30% ROE per se. The best in the country, the largest, is still at 22% ROE. Right?
ROE or ROA.
ROE. Nobody is beyond 10% ROE. You cannot get there.
Absolutely.
Mean ROA is 2.5%. So don't make a mistake.
That's right. So, Mr. Tamal, I'm coming exactly with this question of reporting healthy numbers, and that what quite often the regulators observe is the effort towards evergreening, reporting lower GNPA numbers. And I'm holding this book where you have talked about creative restructuring, and you talked about this is something that banks have been doing over the years. And not only this, but there have been various devices that banks have been using over the years, including lending through AIFs, multiple rounds, and Rajan Sinha used the word zombie banking. So this is something which has been talked about in the banking circle over the years. With evergreening being alleged against banks over the years, NBFCs were also alleged of evergreening, and 4 of them were given the so-called cease and desist order. But if this is what happened with banks over the years, we would probably have no banking left in the country as of now. What is your take on the situation of evergreening, and in what way do lenders, and what way lenders have been doing this, and how do you look at the NBFC action in light of the attempted evergreening over the years, Mr. Tamal?
No, banking sector's practice of evergreening, as you rightly said, it was quite rampant, and that created all the problem. 2014, I'm talking about, when at least 2 banks had almost 1/3 of their assets bad, and overall bad assets were historic high. And that prompted Reserve Bank of India, Mr. Sinha is here, he would remember, and he was probably knew, I had an inside view of that, which I had in my book also, that AQR, asset quality review, which happened there, and essentially which RBI said, look, we don't trust your numbers. Let me get into your kitchen and bedroom and let me see what's happening there. And that's how. And it was given 6 quarters to come up clean. And then everything came out. It actually extended beyond 6 quarters, meaning AQR stopped 6 quarters. But then the bank's balance sheet showing weaknesses beyond 6, I think it went to about 8, 9 quarters. And then COVID came, and the post-COVID things, as you said, things is pretty good at this point of time. We are the best. I mean, we had never seen such a. This quarter is not as good as in the previous quarter, but till the last quarter, every quarter was better than the previous quarter. So that's the banking story. As far as NBFC is concerned and evergreening, I think it's evergreening. It's essentially. Essentially, this evergreening, I don't think RBI is too much of concern about evergreening. RBI's concern is more about over leveraging. And this is not that I am one NBFC, I am I am taking all the exposure and I am giving you 10 loans. What is happening is this: a borrower is taking loans from not 10, 15, 20, 30, and basically one loan is taken to pay off the another loan. So this is evergreening for the industry, you can say. It's not for one particular entity, but one particular is not entity giving multiple loans. This also happened during COVID time. The CGTMS money has been misused and all sorts of things happened, etc., both by banks and NBFCs. That's a separate story. But as at this point of time, I think more evergreening by the industry, not by one particular NBFC. People are getting more loans and to pay off the earlier loans. That's the kind of thing. And one thing you did not ask me, which Mr. Chandan Sinha said, I just want to add. I think all these things, the new phase started with Reserve Bank of India giving the freedom. He said freedom, it's not freedom, but flexibility. I mean, that's semantics. But it happened is this: when RBI, earlier it was depending on your assets, either it was 10%, 10 percentage point gap or 12 percentage point gap on your cost of fund. That's why you could have, you should have priced your loan. Now RBI gave it freedom. And RBI said that you use it judiciously, you get the board approval, so on and so whatever you are doing. Now, apart from the fact that some of the entities are taking the borrowers for a ride, charging loads and loads of penal interest, etc., because they poor borrowers, they are not financially educated. That's one part of it. Selling multiple things from solar lantern to fridge, TV, etc., and loading all those costs. I mean, those days have gone where only the financial instruments were sold, assets like mutual fund or an insurance. Now it's all physical assets being sold. If you don't take it, you will not get your loan. So you add up all these things, it will be 40, 50, 60%. So they have misused that freedom. At the initial stage, when people asked them that you are charging higher, they said, look, COVID, we have made so much of losses, we need to. But they never gone back to that. Now, do we blame Reserve Bank of India for that? I think we can blame Reserve Bank of India if accident happened on a road for infrastructure development. Government creates fantastic road, and we are supposed to follow the 80 per kilometer per hour limit, but you go at 140. Then the accident will happen. We cannot blame the government. I think that's what has happened. Probably the traffic cops should have been more alert. And here the traffic cops are the SROs, the self-regulatory organizations. The industry has at least two of them. So I think they have been caught napping. Otherwise, it should not have happened.
But Tamal sir, I'm sure you are referring to microfinance institutions when you're talking about SROs and talking about the lending cap that was limited to microfinance. But currently, the NBFC scene has a huge number of personal lending retail focus NBFCs other than the microfinance
Yes.
for which there is no such regulatorily empowered SROs. The RBI's invited application as of now there's none, and there was no lending cap either in any form, be it in form of net interest margins or lending caps anyways.
Just see, 2011 RBI freed the savings bank rates. Okay, it was 4%. It's freed now. You see, certain private sector banks, they did raise the money 6.5%, 7%. They got a lot of instruments, lot of improvisation they did and all. And but State Bank of India, as we speak, if I'm not mistaken, 2.75% savings bank rate.
7-0.
There are others 3%, 3.5%, 4%. Now, that shows that the freedom you need to have judiciously looking at your balance sheet. That's of course on the liability side, but that's how it was used. Now it's because it's on the asset side freedom, and you hit the root. And you are talking about what is the rate is important on the percentage. Yes, you give you a classic example. I suppose I start giving loans to vegetable vendors, and morning I give 1,000 rupees for them, and evening I collect 1,010 rupees. So I'm charging how much? 1%. But you can calculate 12 hours 1%. So one day 2%. 2% multiplied by 360. I'm charging 730%. So it's the optics. How do you manage?
You're right, sir. Absolutely right. But taking on your example of overspeeding on an excellent road, and that is beautiful examples. I like to pick that. You said there the SROs, the traffic inspectors should have done the job. Now the other way one can monitor is by the speed cameras. And the speed cameras send you a warning notice that you are overspeeding. Like most of these days, the cameras say you are reaching 60 or reaching 70, so slow down. And when the cameras say you slow down, people are not actually meaning to speed. They probably might have sped on the pressed on the accelerator by mistake. They're not actually meaning to be daring sort of speedos. Here again, Chandan sir, if the RBI advised entities to improve their practices or gave them warning signals or gave them some supervisory notices, that we notice the following things and we would take action unless you mend your ways in the following order. Like in case of gold lending, they came up with advisory saying these are 4 or 5 things that we found. I think 6 or 7 things they mentioned that these are things that we observed. And I give you time till 31st December, mend your ways and report back that you've done that. If you don't, in that case, actions will follow. On the contrary, in this particular case, the RBI came with a cease and desist order. And my question, Chandan sir, with I think over 3 decades of regulatory experience as a reserve banker yourself, in the past we've seen monetary penalties. In some limited cases, we've seen segmented cease and desist order, but cease and desist order which is completely, I mean, wholesome, saying stop your business altogether, almost like putting the company into an incarceration mode because they can't do business anyway other than servicing their existing loans. What's been your experience in taking such a, I'll call it severe for want of a better word. What's your view on taking such severe action? Part 1. And number 2, what's the internal process to be followed for taking such an action? Chandan sir.
Okay. So cease and desist as a supervisory tool is gaining ground, for sure. That is what is, apparent. And it is actually forward looking, and unlike penalties which are in response to transgressions observed mainly in course of inspection. So that's a separate track altogether. There's a show cause. You have a chance to respond. There is reasoned, response by RBI, and then there is a personal hearing. So principles of natural justice are observed there. Now, this one is more like a bitter pill, which ensures that you repair or rectify before you proceed further, especially with new business. It doesn't really stop all kinds of things, mostly some segments or new business for sure, because it was not being done on prudential kind of norms. It certainly causes a lot of pain in the short run. And, looking by a few examples, which banking and other side, I think most people have been able to rectify in, say, about 2 quarters. Some are still going on, but I think there are 3-4 examples, roughly about 6 months, 7 months. These are for, NBFCs and MFIs. These are much smaller, fixes, I would say. It could be fixed much shorter, but as it was mentioned rightly in the beginning by several, speakers, that it conveys a very strong message to the industry at large, So it is, the purpose is somewhat different, but the pain, of course, is huge on which gets kind of impacted. So there could be, as you go, there could be other ways, as you mentioned, of dealing with it. It could be, you give a particular notice and a very strict timeline within which you show progress, failing which it will be followed by a harsh kind of a thing. So that would kind of solve. But here in these cases, I don't know, because I saw that in June 2024, the governor had mentioned that we have observed certain things and our supervisory team is in conversation with them. So this is not, this may appear very sudden and abrupt to, us at large, but it may not be for the entities which are concerned. I don't think it can be something which, is come as a shock to them. It's certainly a shock to the system. Companies would certainly be knowing that something is going on. Of course, there are other stakeholders, like employees, and, shareholders, other people may not be knowing, their service providers, but it's not, this is not something you can do in isolation and without the company, getting anything. A lot of conversation and discussions would have taken place. Second, what you asked me, how this is done. So, without doubt, I can say that there is a stringent internal process and escalations to the top before such decisions are taken and conveyed. So this is not something that, it can just be triggered. It's a very conscious kind of a thing, and it certainly must be escalated to the top for, if nothing, at least for the information prior to, doing it.
But sir, you also mentioned that when it comes to penalties, there is a process. There's a process of show cause and there's a hearing, etc. but for the cease and desist, at least formally, there is no necessary process of show causing, etc.
So I don't know what actually goes behind the scene. So now what you are mentioning, actually the two issues, as I said, which arise from this. One is this perceived suddenness of the supervisory action. I'm saying perceived because it may not be in real sense for the entity. And the other thing is, the reasonableness of the RBI action. Was it reasonable or it is unreasonable? So the first, is easy to address, like you yourself suggested. It could be a two-step process where RBI formally advises the regulated entity of the concern with respect to the business practices or whatever which is there, specify a very tight, timeline to fall in line, failing which it will take serious action like cease and desist. So that's possible. It is possible that even in such cases, it may have been there, but we do not know. This would actually largely take care of almost all the cases, to my mind. The second, of course, I think sometime you did mention about appeal, and or at least when the topic was being introduced, having recourse to an appeal before an independent body is certainly a desirable objective, and this, I think, this will eventually happen. But my limited thing is for the kind of what we have seen, it could be addressed to a two-step process, because most entities would like to fall in line and get on with it. These are irritants which come. They would like to overcome and get on with the business. There's much at stake. So I don't know, but of course, nobody can say that there should not be a process where appeal. You can't argue against that.
The keywords are still fair and transparent.
Yes.
Was it fair?
Yeah. Fair and
was action fair? Was it transparent?
Yeah.
Right.
Are you doing business for the right reasons, or are you, a little kind of wayward?
Now, I was saying also for the regulator, was the action fair?
Yeah.
So these ideals of fair and transparency are not one-sided; they're both-sided.
No, they're both-sided, but the perception may differ. If you ask public at large, they would be saying this is fine. This is, they would not be doing it. But when you talk to a segment of the concerned industry, it will be different. So
right,
that's true, but I agree. I said that is not something which anybody would, argue against.
Absolutely. Anand sir, I come to you, and particularly as Ms. Sinha also was talking about process of natural justice, there was a very important committee report, Justice Sri Krishna committee report. This was Financial Sector Regulatory Reforms report in 2013, which had specifically talked about separation of powers of the supervisor and the adjudicating body. And that specifically I can cite experts, but I think that's not important here, which says that the person who is taking decision to pass an order should not be the one who has also done supervision, because then you end up becoming judge of your own case. Because I'm the supervisor, I have observations, and I'm the one who's able to pass orders. The predicament there is that I might become over induced by what my observations are, and which is not part of the so-called natural justice. And Justice Sri Krishna committee also talked extensively on including all financial regulators into this separation, pursuant to which SEBI has done it. But I don't think, at least in public domain, we don't know whether RBI has done the separation. So Anand sir, what's your take on the separation of powers of the supervisor in the so-called, it's not adjudication in that sense because no one is imposing a penalty, but probably in terms of impact, the cease and desist has even more greater impact than mere penalty. Anand sir, over to you.
Sure. No, so I mean, certainly, as part of principles of natural justice, there is a requirement to separate these out, right? So no person who is, if you look at it from RBI standpoint, they are not only drafting the legislation or the regulation, they are also supervising it, and they're also sitting in adjudication or deciding upon the consequences of non-compliance thereof, right? So it's only one body, one regulator, which is effectively looking at all these. Of course, I think there is a recognition that it is a unique regulator, right? It's not like any other regulator. It's a very distinct regulator. It's fundamentally different from other regulators. It's a monetary authority. It's got regulation to govern our financial institutions. It plays several other sovereign functions as well. So it's a complex sort of situation in that sense to be in. But fundamentally, therefore, without impeding on its authority, on its autonomy, is there a way a mechanism that can be carved out, where at least the persons who are legislating or who are supervising are distinct even within the authority, where, the way SEBI has created SAT effectively, so there is a SAT appellate tribunal which is available. In the same way, if there is something available from an RBI standpoint, that is something which would certainly be lauded upon. Because the only remedy today which financial institutions have is effectively approaching court under writ jurisdiction, right? And therefore, today it's going to a court where maybe the judges are also, the matters are complex. When RBI is taking it up, those matters are complex. They require technical expertise as well. So it's not only sitting in adjudication of a particular matter where it's interpreting the law, but it may require some amount of technical expertise. So there's a bench which is constituted, which has the technical expertise as well as the judicial prowess in that sense. That is an ideal situation which one should hopefully, and as per the recommendations of the Sri Krishna Committee, it should effectively be implemented in my personal view.
At least the power appeal that you talked about, because that's, I think, one very, very fun right of recourse. And I think no part of the entire democratic system can be left without a right of recourse. And you mentioned about RBI's unique position, that's well recognized, but there's a 2022 Supreme Court ruling as well, which talks about RBI being a regulator from the womb to the tomb.
Absolutely.
From the time you're born till the time you die, the RBI is a regulator. So in terms of regulating the financial system, without doubt, they have lots of other functions, being a central banker to the government, being a issuer of currency. They probably have very macroeconomic functions too. But when it comes to financial sector,
very
doubtlessly, yes.
We have to appreciate one just small differentiation. The differentiation is of a contagion effect, right? So think of this way. So there are other regulators in financial sector which are rule-based versus RBI is a risk-based regulator. Lot of time things are not prescribed in black and white for RBI regulatory purposes, and overreaching powers have been given to RBI because it is containing the risk, not the rule. In SEBI, everything is prescribed. So there is a law, there is a rule. If you breach that, there is a penalty and you can appeal for that and somebody can adjudicate. If an insurance company go insolvent, Insurance Act provide the power to IDA to take the policy holder and transfer it to another insurance company. Nothing would, come crashing. So if one insurance company in India fail, insurance sector won't come shut down. If one broker in capital market fails, it won't shut down stock exchanges. If a large NBFC, and we have seen that in case of DHFL and IFS, if a large NBFC fails, it can take down one or two banks, it can take. Then the one bank failing because of a large NBFC failing can take down two more banks, and the whole financial system would collapse. So one of the reasons that why everything should not be litigated and adjudicated, RBI has been given the power to control the risk, not the regulation. So I think we should be very clear.
Fair point, Mr. Nar, that risk of contagion. Anandji, I'll just come to you, but the fair point that risk of contagion exists in the financial system. Well, to an extent, it exists in insurance segment also, because one insurance company dies, whole lot of commitments it made to people because it was the one who was supposed to be transferee of the risk. Transferee of risk itself becomes prone to risk. The risk transferers will all be left without a remedy. So there's a contagion is something which is there in the financial system itself. In fact, in the past, we've seen insurance companies debacle leading to financial risk. In the GFC, for example, several insurance companies were the first to die. And that resulted into a complete contagion impact. But that's an important. Anandji, you were wanting to add something?
No, I think the point is, yes, it's well recognized. I think the role, therefore, I said it's a very unique sort of proposition, the way RBI is as a regulator. But I think, again, having no recourse whatsoever is, I think, equally dangerous, right? Because you have seen, and again, in the public eye, something which seems excessive. Look at several banks, for instance, right? 2020, a large bank was stopped from issuing credit cards. Recently, another bank, similar situations have happened with another bank. You've seen certain payment banks undergoing, again, cease and desist. So I think at each leg, the exemplary action has been probably far too great, and maybe not without cause. So I'm not getting into that debate, and it's not in my position to really judge whether that was with cause or without cause. But I think some sort of regulatory mechanism to be able to have a oversight over a decision which has been taken, and it need not be therefore outside that body, but within that body, a sort of a, because at an individual level, it will be officers within the system which are taking those decisions. And yes, there may be a hierarchy within the organization to be able to say if a stringent action is to be taken, it needs to sort of go through a certain waterfall mechanism before that action is spelled out. But at the same time, it's important that there is a separate, within the system, at least a separate body which is able to adjudicate on some of these issues. And I think that's the limited part which was my point of view.
But it may be an action with a cause, but may not be an action without recourse, without redressal. Chandan sir, you were wanting to add.
Just somewhat related, but not trying to answer this. See, that in the penalty, process, which, RBI started somewhere 2016-17 somewhere, they tried to create some kind of independence within the RBI. See, ideally, of course, it has to. So what was the thing? The supervisory department, actually, pulls, they have a report and there are, whatever translations are there. So that report moves to a separate, enforcement department, which is, totally dealing. The supervisory department there does not itself take the further action, where it is separately examined, and they maybe call out maybe 2 or 3 out of 10 or 15 translations could be there, or sometimes nothing. And then the process of, show causing it, then, coming back, examining it, issuing a reasoned order. Then there, of course, you have a EDs committee, which again has to be, the EDs for that have to be totally separate from supervision and regulation. So, but ultimately, it depends on the credibility which you build over time, or the consistency which you build over time. And of course, there has to be decisions both for and against, what has come to the committee as such. So that's something which is under trial, I would say. I don't think, because we don't have, what should I say, data in the public thing to, what was, say, the first time they examined, say they thought the fine should be 1 lakh. I'm just saying. Then when the response came back, whether it was moderated to 50 or did it go to 1.5, right? And then finally, when the hearing took place, where did it stand? So data like that would probably demonstrate that there is a process which seems to work, but we don't have that. I'm just saying you can more or less try to fix it within. Certainly outside will have, have an issue, it will have more credibility, I would say. But whether, I don't know, the RBI entities, my personal thing is they are very different from the other entities which we are talking of. See, the entity is under continuous supervision, so to speak, and under regulation, So what is it that, will ultimately, what would be a gain, could also be a little doubtful. So I'm just leaving it. I've not thought about it. What are different? These are not just a rule, which is, kind of thing. These are like business models, business practices, business existence, so to speak.
Mm-hmm. So in case of SEBI, the rulings of SAT reversing the orders of SEBI, not just reversing, but once in a while imposing penalty on SEBI. There have been cases where SEBI has been slapped with penalty instead of. So that's all visible in public domain. But as you rightly mentioned, in case of RBI, neither do we know that, nor do we have access of what happens. I'm sure you would have an access, but well, I think people in general don't have that access. Anita, I'm not sure among the audience questions, do we have something that we'd like to pose to either of the panelists or all of them? But if not, then I would certainly request all the panelists to have the last 1 or 2 minutes final dialogue in terms of what is the way forward that they'll foresee. Anita, are there questions from the audience which are worth
So most
putting?
of these have already been discussed during the deliberation.
Right. So Tamal sir, what would be your last final message to the entire audience? The audience consists of mostly non-banking finance companies and banks, all companies that matter in the country. What's your message to all of them in terms of what's the way you would like to see things moving forward?
No, nothing new. Just before that, if you allow me, just one small.
Absolutely, sir. Absolutely. Whatever.
For this, SEBI has what would I say, that appellate authority which Reserve Bank of India does not have. That's the one part of it. Other part of is this: there have been rarely, though, there are regulated entities have gone to the court. Okay, that's there. I think it's slightly different because of the interconnectedness and the financial sector stability. Because again, we don't know what actually has happened. For instance, like one payments bank, even though the cease and desist order was not that cease and desist term was not used, but it was a very similar kind of action that has gone through. But we understand that over a period of last years, there are lots of internal discussions were on between that particular entity on which this order was imposed and Reserve Bank of India. So if you make it open and the hearing system and all, when people are keeping money with say certain banks is happening, and we know that such and such bank is getting and being hard, etc., they'll be run on the bank. So there is we need to treat it in a slightly different way because of this, because it's a financial sector. In that sense, people's money, your money, my money. As far as the message is concerned, I think you have to follow the rules. That's it. I mean, don't take advantage. Don't give the excuse of COVID and we lost so much of money. We need to do this thing. Don't. It's a. I think RBI has said that it's a phenomenon driven by push factor, not demand driven. So that says everything. Why do you have to push? Why do you have to look at your, it's just balance sheet growth and making money and under the pressure of your investors and all, everything RBI said. I think refrain from that. I mean, road is fine, road is very good. So you follow the traffic rules, and the traffic rule is you not only stop when the light is red, even when the light is green. If a child or an old man or anybody, you and me, in crossing road, I mean, those who respect the traffic rule, they will stop, even it's green light. So that's the thing, not followed by only. Yeah, I think there's some problem with the. Yeah,
no, not a problem. We heard you, sir. We heard you. Mr. Nath.
So I would say that, India definitely need credit growth, but more in productive sector. Over a period of last 6-7 years, the credit growth has gone largely to non-productive sector, right? And that I think the industry have to recalibrate. And when I say productive sector, there is priority sector, agri, MSME, so on and so forth. Second, I think so time has come wherein Government of India or RBI or, we have to create a domestic patient pool of capital largely for growing NBFC. Currently, the pool of capital is very hot. It is excessive, offshore capital, either in form of private equity or in form of capital market. There is no need for Indian professional and entrepreneurs to go with begging bowl for capital, which is forcing them to show excessive growth. If we would have a 20,000 crore domestic private equity fund, which is sovereign by nature and provide a 5, 7, 10 years of capital, some of these exuberance would come down dramatically. Third is that I think so within the financial institution, the role of the board has to be taken much more seriously, and board should show their power of, advising the management to create balanced approach and should question. While RBI supervision requires financial entities to be supervised by their own board, but over last 10 years or so, boards have actually not done that job at all. It is the chief executives and their power supersede the power of the board, which is not envisaged, neither it is happening, and that's why this. And last but not least, I think so it's a plea that whenever severe actions are being taken by RBI, there is a little bit of explanation of what need to be done by the rest of the entity so that others can correct. So for example, in the same class, if you have slapped one student and after that teacher doesn't tell rest of the student why this guy was slapped, then the people after, a shock silence of 1 hour, they will again start shouting. So if you slap and then you for 5 minutes, you give this lecture, I have slapped this person because of this behavior, probably people for next 1 week will not shout. So I think so, while you are being slapped, but what you should not be doing should be told more explicitly than not so explicitly. So I think that it should not be left to the interpretation of rest of the pack of their own. I think that this is where I stand.
Chandan sir.
So I would just say that, whatever be the entity, you should always take a long-term view when taking a business call. And actually, if you do it, there would be compliance in letter and spirit, and also there would be focus on business practices and conduct issues. So it's actually the very short-term nature in which you have to operate. As several constraints have been mentioned, it could be the investor, it could be a quarterly results, you could be a comparison with your peer group or something like that. That is where I think a lot of these things emanate from there. So if you have a very long-term view, actually it's very difficult today to take a long-term view even for boards, because there is so much I would say pushback, especially from the investor class, private. So it's difficult to build business, but in this business you have to be a long-term player. Now, I don't know, if you are there, then some of these problems will not come up. That is what I think. Thank you.
Most people these days say in the long run, we are all dead.
Dead, yeah.
Anand sir, what's your take? Final take.
I think just a few simple rules in that sense. Number one, don't try to game the system on technicalities, right? I mean, that's what a lot of people do try and do. So number one, don't do that. Number two, adopt a spirit-based approach, right? I think there is, while there is a certain amount of rule, there is the spirit. We all know what it is insofar as RBI is concerned, I think, over the years, and therefore try and adopt a spirit-based approach. You will not go wrong there. The third is use an approach where if it doesn't feel right, it's not right. Right. The converse may not be true. That if it feels right, it's right. If it's not, the converse may not be true. But if it doesn't feel right, it's not right. I think that's really the gut and feel of what regulation really, because a lot of this is not prescribed, right? I mean, insofar as usurious rates, there is no ballpark. It's open to the market, and therefore there are guidelines which are prescribed, and try and sort of stay in the true spirit of those guidelines. I think these are simple rules. If one adopts, it really culminates into a long-term approach. It's really where the boards themselves will need to take decisions on the basis of some of these factors, and that things cannot go wrong if that is the approach which is taken. But I think where the issue really comes in is, very often we get faced with questions to say, X, Y, Z NBFCs are doing so and so practice. Why can't we do it? Why can't we get a legal opinion to say this is okay? And, we just have to stay away from these things.
I think absolutely well put. I think it's time for us to thank you all, because it's been such wonderful deliberation from all of you. And I hope with these discussions, everyone would be able to drive on this absolutely fantastic road with all kinds of traffic signals and all kinds of traffic restrictions. Bear in mind that we are not over speeding. Bear in mind that it's not just today that we need to be safe. We need to be safe in time to come as well. So let's not live with the kal ho na ho philosophy. There is always tomorrow, and therefore let's all be prepared for today as well as tomorrow. Long run, that's the message for all the participants here. And on behalf of everyone who's present, from all the participants, as also my office colleagues, I must say thanks to all the 4 panelists. It's been so very wonderful listening to you all, and wish everyone a very, very happy Deepavali. Thank you all. Thanks, sir.
Thank you. And thank you for having us on the panel.
Happy Diwali.